Good morning, everyone. Thank you all very much for joining us today. This is our second webinar since the lockdown began last month. I hope you all have been staying healthy and managing to work as effectively from home. I've corresponded with most of you over the last months, but if I haven't spoken to you in person before, to briefly introduce myself, my name is Edward Malia, and I am the Relationship Manager at Blue Whale Capital. Today, I'll be joined by none other than Stephen Yu, who's the lead manager of the Blue Whale Growth Fund. Before I hand over to Stephen, I just wanted to give you an idea and go over of what we'll discuss today and go over the agenda very briefly. We'll be handing off, when I hand over to Stephen, he'll be giving a 25 to 30-minute update on things we've done in the fund this month, a bit of a summary on what we've seen from earnings of our holdings so far, and then just go on a bit about performance over the month and thus far this year. And then after that, we'll open up for some Q&A. Now, we have received a few questions in advance, but you have the ability to ask questions via the app during the webinar, and I'll do my best to make sure that most of them or all of them get answered. Please note, I'll just remind you that you will be on mute for the duration of the call, so the only way to ask questions will be through the app. Before I hand over to Stephen, pleasingly, you'll see from the handouts that I've attached to this webinar, which are a fact sheet and a summary of our top 10. Pleasingly, we've surpassed 300 million in assets under management this month, which is quite a milestone for us. We're very pleased about that, and I'd like to thank you all for your support thus far. And with that, I'll now share my screen and hand over to Stephen.
Thank you, Ed. Thank you, everyone, for dialing in. I hope everyone is keeping safe and staying healthy. And just to echo Ed, I would like to thank you for your support as well, that we have just gone past 300 million in April. And in this year, in 2020, despite the uncertainty in the market, that we have actually got in about 75 million net flows. So that is very helpful for us. So thank you for that. It's actually very timely to do the call today on the 1st of May, Friday, as we have a lot of change since we spoke last month in March. Not just that the market is up about 10% in April, but at the same time, about 2/3 of our holdings in the fund, our 25 stocks, have already reported the Q1 results. This would give us more data points and more reference to make assessment on what's going to happen next. So the agenda would be as follows. I've only prepared for a few slides, so some of the slides that you might just from our presentation, and I've got a few slides. And so the agenda for today would be, I will go through the performance quickly. And then the second one would be what has changed since March in terms of the market versus the economy. The third topic would be about the portfolio positioning. Fourthly, about recent company results from our holdings. And then I will talk about the outlook and also take questions from some of you later. So if I just kick off with a slide on performance, you would have seen this slide already in our last mail shot, but I just want to put it up here to recap what happened when we spoke in March. The fund was down about 8% in Q1 this year versus our peer group at 15.6%. And when we started the month in February, we had about 11% cash position in the fund. And during the period in February and March, we managed to redeploy quite a lot of this cash into our best ideas at a more attractive valuations. So the cash level at the end of March was at about 3%, and at the end of April, as of yesterday, it was at about 4.4%. So I just want to put this slide up to recap what actually happened, because certainly the market has recovered quite strongly in April. So if I go to the next slide, this is just an updated slide on the performance since launch that you would have seen in the table below, that we are now back in the positive territory of up, with the fund up about 2.6% in 2020. And then since inception, the fund was up 46% versus 12% for our peers. And the net annualized return would be at 15.5% versus 4.3%. I think what is interesting is, I mean, you probably would have done your own analysis already, but I think what is interesting that our outperformance gap versus the market has actually gone up over the last few months. So back in March when we spoke, the relative outperformance to the IA peers was at about 7.6%. So if you just refer back to our last fact sheet, and if you look at this month's fact sheet, that the number now got closer to about 10%. So we're at about 2.4% outperformance in April. And I would give you more color on how this come about in a bit later. The last slide that I will share on our performance is about the consistency. You have seen this slide already before. I think we would try to do our best to keep up with what we have delivered since we started to do well. We are still quite a young company. We are approaching our 3-year track record. What you have got on this slide is the trailing 12-month performance since we started. And you would have seen in April, the gap has just got a bit bigger. So obviously we cannot forecast what's going to happen in the market, for example, in March last month. But I think what we can try to do best is to make sure that we can continue to deliver outperformance, whether the market was in a positive territory or in a negative territory. So this slide is something that is quite close to my heart, that I would try our very best to keep up with the consistency in terms of delivering the performance. So let's now kick off into what we are going to go through in more detail today. Is what has changed since March. And I would break it down into the market, which is I would use the S&P 500 index as a proxy, versus the economy. The 2 quotes that I have just put it up here was just based on an article that I did with TrustNet a few weeks ago. So I spoke to them shortly after we spoke. So you would probably recall some of this comment that I've made. So I just put it up here. But if I now go into the market, what actually happened? So if I use the S&P 500 index as a proxy, the index is now only down about 15% from its peak in February. And at one point, the market was down about 35%, close to at one point. But now the market is only down 15% from its peak. But then the interesting thing is that the underlying earnings revision downgrades for the market is now expected to be more than 25% this year. So you have the market only down about 15% from the peak, but then you have the earnings downgrade at more than 25% for this year. So which means what? Which means that the market is now more expensive versus the pre-lockdown period in February. And obviously, one can argue that the higher valuation is supported by rate cuts, quantitative easing, and fiscal stimulus. But then what about the economy? It pains me to say that the global economy is in trauma. As compared to the banking crisis in 2008, The first order impact was in our industry, the financial industry, where we employ a relatively small proportion of the population. And also, at the same time, most of us are highly educated, which meant that the transition into other industry would have been easier if we lost our jobs back in the banking crisis. This time round, the COVID-19 crisis, the first order impact is in everything else, which employs the majority of the population. In our view, a lot of businesses are going to disappear on the back of this. And many furlough staff who are now getting subsidy from the government, they probably have not realized they might not be getting their jobs back. And even if they do get their jobs back in time, they will be paid much less than before. I would suggest that it would take the economy a few years to pivot to the new normal. And I think that we haven't even started that journey yet in the economy, on the economy level. In contrast, the market, which is a collection of banks, oil and gas companies, retailers, travel and leisure companies, and highly indebted companies, I would suggest that the market is under some sort of illusion that the COVID-19 crisis is just a blip, rather than factoring in the structural challenges that I outlined above. At Blue Whale, we do not forecast macro, but I would suggest that there seems to be a disconnect between the market and the economy after the massive rise in April. Luckily for us, that's not what we do at Blue Whale. So we do not forecast macro. Our expertise lies in business analysis and to forecast earnings. So which brings me to the portfolio positioning. What to expect. On the slide that you see here, I'm sure you would have seen this article already from TrustNet, which I did at the same time as the previous one, that I have outlined 2 stages on how Blue Whale is going to recover in absolute terms. Of course, 2 things just to bear in mind. The first one is at the moment, we have only invested into 25 companies. And there are few thousand companies in the world. So if I do suggest that we feel quite confident or feeling positive about the development of the companies, I'm only referring to the 25 companies in the fund. The second point I would make is the cash level is now at about 4.4%. And given where the valuation sits, including some of our holdings, I might not be surprised that the cash level could go up from here, but we are definitely not making a call at the macro. So everything that we do is focusing on the relative valuation of our stock versus the market. And I will give you one example later on. So basically, what are the 2 stages? The 2 stages that I outlined, the first stage is in this coming earnings seasons, which we have now probably 2/3 of the way done, that would be a clear segmentation in the market about companies who are going to take a big hit to earnings and companies that would not have a similar impact. At the same time, we will also have companies that would be a net beneficiary on the back of the COVID-19 crisis. This is the first stage, which is about differentiation of companies' performance in the market. And I will I would be able to give you more color on that. The second stage, which is very unclear, and we definitely do not make any forecast on how this is going to play out, is about when do we get out or recover from COVID-19? When do we actually have maybe some sort of vaccines? When does the population started, the economy or the population started to go back to normal? That would take time. But and that would be quite a key factor in determining where the market is going to trend. But the interesting thing about the first stage is once the differentiation has been made, then you would start to see some clear winners. So despite the fact that might be the COVID-19 crisis is going to be extended, some of our companies are going to continue to do well on the back of this. So in terms of this, I would suggest that we are probably 2/3 done in terms of the first stage. And the other way to think about this, which I would now give you the example, is if you use Microsoft as an example, that the shares was down at one point, which we spoke about in March, from peak to trough, from February until the low point in March, the shares in Microsoft was down about 25%, in line with the S&P 500 index. So the S&P 500 index from the peak on the 20th of February was down 25%. Microsoft was also down 25%. Obviously, based on our forecasts or understanding of the business, which have also been confirmed by the company 2 days ago when they reported, that the likely earnings downgrade from Microsoft would be significantly less than the market. So which means at the point when Microsoft was down the same proportion as the market, the Microsoft was trading at a very attractive valuation. And that's when we decided to increase our position by a few percent. And that's how we managed to redeploy some of our cash into Microsoft at that time. And as of today, Microsoft has recovered strongly from its lows, and from peak to trough is now only down about 6%, while the market is down about 14%. So you can see that Microsoft recovered from down 25 to only down 6, which the shares has actually recovered close to 20%, versus the market, which was down 25 and is now down 14, has recovered about 11%. And this is where the outperformance comes in. So this is how we managed to deliver more than the market in April, because we took advantage of the opportunity in the discrepancy in valuation. So I think that is very important to bear in mind. This is what we do. So we do not try to forecast how the market is going to go, because there's every chance that the market could actually be down more, or the market could go down from here. That's a call that we cannot make. But what we can make, the call that we can make, is how the attractiveness of the valuation for our companies relative to the market. So the likely scenario that you're going to see on the back of this now, after the market has recovered strongly, after the differentiation in earnings fundamentals has become clearer, that we do not expect, if we do get another sell-off from here, let's say if COVID-19 really gets serious, we might have a second wave or third wave later this year. The market might have another big sell-off. We would not expect that Microsoft would see the same sell, we see a similar sell-off as the market again, as we had witnessed in February and March. What is more likely to happen is the outperformance gap or the relative performance gap between, let's say, Microsoft relative to the market would continue to widen from here. So it's important to note that I'm not suggesting that the Microsoft shares cannot go down from here. I'm talking about relative performance of Microsoft. So let's say if the market is going to go down 10% from here, I would expect that Microsoft could go down 5% from the peak. So this is what I'm referring to. So I'm not saying that you should put all your money now into Microsoft, because the only way for it to go is to go up. It doesn't work like that. So that is what I would say about the fund here. So let me now go into some of the specifics on earnings. So within our holdings, we have already seen about 2/3 of the companies reported until as of last night. And within those names, I have picked out a few that I can maybe give you some color on. You would probably have seen our top 10 commentary as well. If not, then please refer to it. So within the stocks that we have in the fund, that if I group them into different themes, that I would put Microsoft and Amazon under digital transformation, Google and Facebook under digital advertising, MasterCard and Visa under digital payment / contactless. We also do have PayPal in the fund, that you will have noticed that PayPal has now just become a top 10 holding this month. I mean, we always have PayPal in the fund, and they haven't reported yet. They're due to report next week. So that would sit under digital payment. We also have seen results from Unilever and medical equipment companies, Boston Scientific and Strikers. So I could probably spend an hour just going through some of these names here. But I think on a high level, that for companies such as Microsoft and Amazon, which I think all of us understood them quite well, so I want to drill into what they do, is you would expect on the back of COVID-19, not only that they're able to continue to make money and grow over the last couple of weeks, they would become a bigger proportion of the world GDP in time. So I would only expect the revenue this company is going to generate, or the share that they're going to get from the world GDP, is going to go up from here. In terms of digital advertising, is quite interesting, this space. So we do not have big holdings in Google and Facebook, just because we are slightly concerned about the cyclicality in the advertising space. But having said that, what they have shown, so the results that reported this week, is there has been a transition, or maybe you would call it a more speedy transition, into companies who are going to embrace e-commerce quicker than before. So if I use Facebook as an example, back in late March, the revenue or the advertising revenue stream for the last 2 weeks of March was down at the low of about 30+%. So obviously, I mean, you would expect a lot of companies are going to cut back on advertising spend, etc. But then in April to date, I would say maybe it's too early to tell, but at least, I mean, we have a good few weeks that compared to this time last year, the revenue growth was flat compared to this time last year. So it implies that they are no longer seeing the advertising budget getting cut back. They have actually seen companies who didn't used to embrace e-commerce as much are now spending a lot of money advertising on social media, etc., which you would expect, because when we have everyone staying at home, you spend more time on Facebook, Instagram, etc., then it only makes sense that this is where the business takes place. So it would be sensible for any high street retailers to make the transition to start doing more e-commerce business. Within the I wouldn't go into the payment or the staples, but then I would highlight the medical equipment, which we did talk about last time, that we have seen positive trend in terms of some of the hospitals, in particular in the US, is about to be opened up for elective procedures. So during the first couple of weeks of lockdown, with the hospitals fully occupied by COVID-19 patients, I would say unfortunately, all the elective procedures would be postponed. And also at the same time that the medical equipment company would have seen a negative impact to their earnings or revenue. But the difference between the medical equipment companies, elective procedures, versus the likes of travel and leisure companies, high street retailers, even hotels, is that the business is not lost. It's only been deferred. So if you need to replace your hip or knees, you need to do a heart surgery, you will need to do it at some point. So that you can't do it now, but once the capacity come back online, then you would want to do it as soon as possible. So we are still feeling quite positive about the medical equipment companies. But the difference between the medical equipment company versus, let's say, the likes of Microsoft and Amazon is they have seen significant impact on their business since the lockdown started. So of all the companies that we have seen the results, we are quite pleased. None, I would say, not much have surprised us since our conversation in March. A lot of things a lot of these companies are saying things that are in line with our expectations. So what's next? So going back to my previous slide, I would suggest that the valuations discount that we saw in March is probably gone. So the game for us, sorry, not the game, but I think the play for us to be able to capture some of this company at a significant discount to the market is going to be harder from this point onwards, given the recovery in the market, given the earnings that some of these companies reported. So what are we going to expect from here? I would suggest that from Q2 onwards, which is now, is all about the strength of the underlying earnings momentum for companies. I would expect that the performance of companies in share price terms would continue to widen. We would expect to see some real clear winners and some clear losers. So which brings me to the last slide, which is the outlook. So what's our take on this? We are not out of the woods yet, especially in the real economy context. If I borrowed MasterCard's analogy, which they reported 2 days ago, they suggest that there are 4 phases for the economy. The first phase is containment, which is basically the lockdown that we've seen, or we're still in the middle of it now. The second phase is stabilization. The third phase is normalization, then followed by growth. MasterCard suggests that given what they have seen in April, in line with some other results that we have seen from other companies, that we are probably in the second phase, which is stabilization, which means that the peak to trough impact or the loss of activities, we would have seen the worst in terms of the rates of change, not in absolute terms. This is all about rates of change, that we are now stabilizing, which means that we are recovering slightly, but then there's still quite a long way to go before we get to normalization, which the world or companies need to get used to, that the world GDP is going to be smaller from here. And the companies need to operate, the company need to readjust themselves to operate in a smaller environment. And the last stage, which we have no idea when this is going to come, is the growth phase. When do we get back to normal? When do we start seeing the activity that we saw before the lockdown or before COVID-19 started in China last year? So we are cautiously optimistic, especially about companies in the fund who are the leaders in digital transformations. So I put up two quotes here, which I thought is well summarized what I'm referring to. The first quote was from Google, Sundar Pichai. In the conference call with Google, he suggested that a lot of traditional retailers, let's say the car retailers, they are now thinking about virtual car showrooming. Obviously, a lot of these kind of things have been in place before, but a lot of companies probably have postponed the inevitable, that we are moving to a more digital world. Business are done in a digital manner. So I highlighted the word is in a deeper way, which means that the conversation get more serious, that now it become a priority. Because in time, you can expect, even if we do have some sort of relaxation in the lockdown or social distancing rule, you would expect that there's some permanent change of behavior, that we are not going out to shop on high street as much as before. So a lot of companies need to readjust their way of doing business. The other quote that I thought was quite interesting, obviously, I don't actually know whether that is true, but it would be on a similar trajectory, is Nadella and Microsoft basically said that they have seen 2 years worth of digital transformation in just 2 months. That's exactly what we expected, or what we said back in March, is you would expect an acceleration in digital transformation on the back of COVID-19. I would probably leave you with one more point, which it depends on which way you take it, to read into this, is I would also suggest the longer this lockdown get extended, or the longer this social distancing get extended, the companies who are leading digital transformation will benefit even more. So which means that if we're going back to normal tomorrow, then I think a lot of old habits would go back prior to COVID-19. But if we get another 6 months or even 9 months that we're not going back to normal, these companies are going to benefit even more, that we are truly going to embrace digital transformation. Before I take questions, the last point I will make on this is just a reference point for you. Even within digital transformation, you need to be very careful that there are a lot of differentiation among companies that appear to be a beneficiary of digital transformation, but it does not hide the fact that some of these companies are low quality businesses in terms of the business model they operate in. So for example, any names that we have in the fund, of course, we would term them as very high quality businesses that would benefit on the back of digital transformation. But names such as Netflix, Spotify, Zoom, which a lot of people are using now, I would suggest that they are low quality business. They might be doing well now because a lot of us are now sitting at home, are going to sign up to Netflix, are going to sign up to Spotify. We are going to use video conferencing via Zoom, but then it does not change the fact that their business models aren't built on a sustainable competitive advantage. And of course, the space that they operate in is extremely competitive. So it does not change that. So we are not interested in those companies. So we are highly selective of what we do. And hence, everything that I talk about today is only about the 25 companies that we have in the fund. Right, happy to take questions.
Perfect. Thank you very much, Stephen. Thank you for that overview. I've had a few questions come in. The first one is has to do with whether it's too early to see the clear winners yet. People will use their experience of what they're using, for example, Zoom, which you just mentioned, and think that these guys will be winners. So do you think it's too early to spot these winners yet?
It's a good question. I probably can expand on what I was just about to say in my last remark. For the companies that we have in the fund, we are very confident they are the clear winners even before they reported their earnings. On the back of the results that we've seen this week and last week, we are even more confident they are going to be the winner. Unfortunately, for any other names outside of our fund who might appear to be a play on digital transformation, if I use Zoom as an example, the problem with Zoom is not about that they are not doing well. It's not about that we are not signing up to embrace the Zoom experience, means video conferencing with a lot of people. It's about the competitive advantage in the business model. To put it simply, as far as Zoom is concerned, there's no lock-in. You and I could be using Zoom or even the app that we use today called GoToWebinar, which is operated by another company. Tomorrow, we can easily use Teams, which is done by Microsoft, to do the same call. And as far as I can tell, the technology that Zoom has can be easily, okay, I wouldn't say easily, but I would suggest that it could definitely be replicated by Google, by Microsoft, and maybe even by WhatsApp. So I do not think they have anything unique as far as that technology is concerned. And in time, that would be replicated. And because there's no lock-in, the switching cost is very low and people would move to a better place in time. So it doesn't change the fact that the business model is low quality. If I just maybe finish off again, I've spoken about this many times already. The problem with Netflix and Spotify is that the competition in that space is huge. You are talking about these while we are, I mean, Netflix is getting close to 180 million paying subscribers, but at the same time, as consumer like us, we would be subscribing to Amazon Prime for video, Disney Plus for their video, maybe Comcast, maybe Sky, etc. The competition for content is huge, and this does not change. You would only expect that the competition would be more intense from here. So the problem with Netflix is not about the revenue. The revenue could continue to grow, the paying subscriber could continue to grow. But the thing is whether they could actually make decent amount of money, which is high return on invested capital. To us, is unlikely.
Perfect. Thank you, Stephen. We've had quite a few questions coming in. So the next one is from one of the listeners who'd be interested to hear our thoughts about Amazon news from yesterday after their update or their earnings update.
This is Amazon is a difficult one. So I probably have said this already in our last call. So it's now it is a top 10 holding in the fund. Amazon is definitely both on the back of the e-commerce, online shopping, plus the cloud being a cloud titan in AWS, is a net beneficiary on the back of this. The difficulty with Amazon is about short-term earnings in terms of how much margin they're going to make, because you would have just heard last night that Amazon is going to spend about 4 billion in Q2 in terms of basically getting their logistic even more efficient in order to cope with the demand, the upsurge in demand. So the top line is something that I don't think anyone would question in terms of whether they would become a bigger company in time. But the timing about how much money they can make over the shorter term period is not easy. So basically, from our perspective at Blue Whale, that the way that we operate is we would make sensible forecasts on what they're going to do in terms of earnings, revenue over the shorter term period. And then we would have to make an assessment on valuation. So I would say, given I would say in terms of, I think the one point I would make, which is quite useful, is we did increase our position in Amazon substantially in March. So before March, it was not a top 10 holding. At the end of March, it was a top 10 holding. And of course, the shares has recovered over 40% from the low in March. So in terms of valuation, in terms of what's going to happen from here, relative to some of our other holdings who haven't seen as much a recovery, that on a relative basis, that I would not be surprised that maybe Amazon is trading at a less attractive valuation versus some of our other names. So in time, if you don't see Amazon in the top 10 again, then it would be just a byproduct of the valuation exercise. So we still like the company a lot, but it's all about generating outperformance within Amazon versus other holdings.
Thank you, Stephen. The next one has to do with Unilever and our thoughts on their update, and a bit more about why we feel Unilever is superior to the other consumer staples companies out there.
Unilever is an interesting one as well. I think without the COVID-19 crisis, it would be very unlikely that you would expect Unilever to show up on our top 10. So I think it's just as simple as that, right? So Unilever definitely have not got any of those drivers that I mentioned in digital transformation. But of course, when we make forecasts or to understand about how business operate in the context of the market backdrop, then that's important as well. That Unilever being a staples company, being quite financially sound, trading at, we would argue that a very attractive valuation versus other staples name. At the same time, paying about, I think, just over 3.5% dividend. That is going to do well. So when we say do well, it means that it could potentially outperform the market. But of course, the range, if you haven't heard this before, that within the mandates of the fund or maybe the trailing 12 months performance chart that you've seen, that over the medium term, we do aim to achieve 5 to 10% outperformance on an annualized basis, 5 to 10. And in the context of Unilever, a low growth company, then we would expect the number would be at about the 5% range if we can actually buy Unilever at a very attractive price. But for other companies, such as the company that embrace digital transformations that are net beneficiary on the back of this, we would expect the number to be trending close to, let's say, 15%. So if you net the two together, then we get to about 5 to 10. So I think on Unilever, I think what I would say is you can expect that once we started to get back to normal in terms of the economy, in terms of the COVID-19 situation, etc., that we would not expect to see Unilever in our top 10 on that basis. So whether it would still be in the fund, then we would have to make assessment on how Unilever fare with other staples company.
Thank you, Stephen. Another question has to do with the inclusion of Stryker into our portfolio. I know you've discussed why we like medtech at the moment, but he's asked whether we're starting to get a bit more positive on Smith and Nephew as a result of this. I'm sure you have a good answer for that.
This is a brilliant question. I mean, I'm quite impressed with the quality of the questions. That we have actually debated about Smith and Nephew quite a lot, only about a few weeks ago, just in April. And just to recap for other people who haven't followed the story about Smith and Nephew, that we had a position in Smith and Nephew since, I think, summer of 2018 or late 2018, on the back of the management turnaround story. And then we sold out of the company completely during the summer of 2019 because the chief executive decided to leave. So the thesis got violated in terms of how we feel Smith and Nephew is going to do. So on the back of that to start off with, without good management team, Smith and Nephew is a lower quality business compared to Stryker. That is something that I have always said, that the reason that we were interested in Smith and Nephew versus Stryker at that time was because not only the valuation was attractive, but secondly, the new management team is very high quality. So if they manage to do the turnaround, then Smith and Nephew would become a higher quality, maybe still lower quality than Stryker, but will be higher quality compared to before. But unfortunately, the management team left, or the CEO left last year. And for the last few weeks, we do like MedTech. I'm sure you heard it from us already when we spoke in March. And we were just looking around to see what other companies that could actually be beneficiary on the back of when the hospital gets the capacity got free up. And Smith and Nephew obviously pop up on our radar that we discussed, but we could not actually bring ourselves to to give it a pass for Smith and Nephew, because I think as far as the quality of the business is concerned, it hasn't passed our hurdle. So we do have quite a high hurdle. And you could probably argue that the valuation is looking attractive now. It's now trading at a discount to Stryker compared to the time when we sold Smith and Nephew last year. That Smith and Nephew was trading at a premium to Stryker, which was interesting. So we did not actually act on Smith and Nephew, and I think this is quite important for you to make a note. We do have quite a high bar for our company to make it into the fund. And this is not a thematic fund, that we're not trying to play some sort of theme to say, oh, yes, this is digital transformation. This is like medical equipment company. Why don't we just get a basket of company that would see some benefits? That is not what we do. The business quality would still need to be intact. And sorry, I'm giving you a very long-winded answer here, but as far as Smith and Nephew is concerned, that we do not feel as of today is going to, has not passed the test, despite the fact that it might benefit from a recovery in hospital capacity.
Thank you, Stephen. Another question here regarding stocks. They're just asking your thoughts about the massive success of Disney Plus and whether you think old school companies can reinvent themselves. This is in the light of even Netflix CEO being quite impressed with the 50 million subscribers in less than 6 months.
Ed, I'm just conscious of time. Can I just ask how many more questions we have so that I can tailor my response?
We do have a couple more that have come in.
Okay, I would try
to keep it quite brief on this one.
Yeah, sorry, but yes, I would just keep it a bit brief, and if you want to have more color, I'm sure we can come back to you on this. I think the Disney is an interesting one as a company. We do cover Disney as part in our universe. I think there's something that we are still not comfortable with Disney is the transition from the old business model, which is they still make quite a lot of money under the TV channels like ESPN, etc. Whether the transition they made to online, let's say Disney Plus subscription, etc., whether they could maintain the same level of return on invested capital. So we do look at it and we constantly debate on this. But I think the problem is at the moment that we haven't got the level of comfort. So I'm not suggesting that they can't do well on Disney Plus, same as Netflix, getting more subscribers. But at the end of the day, you need to make money for the things that you do for consumers. So the price that they're charging in the US for the first 12 months is like half the price of Netflix. Could they actually make any money in it? In time, they probably need to raise prices. But can they actually raise prices given the intense competition from all other places? So we haven't concluded on that yet. But as of today, that Disney has not passed the test.
Thank you, Stephen. Another quick one, which a couple of people asked regarding our views on Chinese heavyweights and why we have little Chinese exposure. As in, a question about the Tencents and the Alibabas and JD.com. You have quite a clear answer for that, so might be good to clear that up.
Yeah, it's just part of our investment philosophy. Obviously, I'm originally from Hong Kong, so I do speak the language. And in my previous career, I had covered some of the Chinese companies listed in Hong Kong. I've done quite a few trips to China in my previous career. So I would say I probably have a decent understanding of what's going on in the Chinese company space. I think the thing in the context of this fund is the quality for our company is quite high, and obviously for anything that's outside of the developed markets, let's say China, then the corporate governance is always a concern. We sitting here in London, we're definitely going to be the last to know what's going on within the economy, within the policy, and what's going to happen. I mean, in terms of the visibility we get on earnings, the breakdown, etc. So I wouldn't say that we rule them out completely. In time, they could become interesting. But I think it's important to note that even if they do become interesting, that it's unlikely that they would be a big proportion of the fund. So if you ask me to put a number, we have nothing today, but I would suggest a number would range probably less than 10% or definitely less than 20% outside of the developed market if we're interested in those space in time. So they would never be a big feature of this fund. But as far as today is concerned, we have no intention of going into those markets.
Thank you very much, Stephen. With this, we have 3 minutes left, and we want to keep it to within an hour. Maybe you'd like to give some final remarks to our listeners before we end the call.
Yes, I think thank you everyone for dialing in. It's always good to chat. It's actually good for me as an exercise to put my thoughts together, so everyone knows what's going on within the fund and how we are positioned, what we're seeing. I think one question that's not been asked, and it's a question that we do ask ourselves within the team here, is what have we learned on the back of COVID-19, and whether there might be any changes in terms of investment philosophy or investment process. I think I would just maybe give a 2 minutes conclusion on this question. I think firstly, there's no change in investment philosophy. It's exactly the same. I would say that the COVID-19 crisis has only strengthened our belief or our philosophy in investing into very high quality businesses. Hence, we can sit here in March, so not today. Today is a bit more comfortable now given the recovery, but back in March that we were feeling quite comfortable with our companies. So I think it just reinforced our belief that this is the right strategy, this is the right philosophy. Obviously, in terms of the implementation of the philosophy, the investment process, that we have learned a lot. We have refined some of the things that we do in terms of modeling, in terms of the assumption that we made, in terms of how we operate under real-time stress in the market, with our shares down 10-15% intraday, and we could actually act quite quickly while there was so much noise in the market. So without this experience, that we wouldn't have implemented some of the stuff in the process going forward. So I think in terms of that, is a very positive. And of course, the last point I would make on this is before COVID-19, everyone, or in the market anyway, would make a recession scenario modeling of any companies using the last banking crisis in 2008, 2009, how the recovery is trending. From this point onwards, or this time next year, everyone would be referring to the COVID-19 crisis. And I think the differentiation across companies, how different in terms of this crisis, the impact that you wouldn't have expected to happen to those companies in a recession are now happening. that I think it would change a lot of perception about some of our companies in the fund as well. So, which means I would not be surprised that the market in time could pay a higher premium for some of the company in the fund. So hopefully that would translate into even more outperformance from here. I think that's all from me. Thank you very much, and hope everyone would stay healthy and keep safe. And I'm sure if you have anything else, please feel free to go back to Ed, and I'm sure we could give you an answer.
Thank you very much, everyone. Thank you very much for your time today and for dialing in. I hope it was useful, and I'll follow up with all of you in next week and to just get your feedback. Thank you very much. Bye.
Thank you. Bye.